The Fed's battle to stabilize financial markets. On March 3, the Federal Reserve slashed the benchmark interest rate by half a percentage point, aiming to align market interest rates with the desired target through open market operations, including the purchase of government bonds. Following this, the New York Fed increased the limits for repurchase agreements, repos, to inject liquidity and counter rising interest rates. Despite these efforts, demand for dollars and pressure on interest rates persisted, leading to further expansions in repo operations, culminating in an emergency injection of over $1 trillion in liquidity. While repos serve as an ultra-short-term policy tool, they have limitations in addressing extreme market panic. Hence, the Fed expanded its strategy to potentially purchase Treasury bonds of all maturities, signaling a possible return to more extensive quantitative easing measures. Amidst increasing emergency declarations and work-from-home policies due to COVID-19, the U.S. government announced a $50 billion support package, focusing on health and emergency responses. Despite these monetary and fiscal interventions, market skepticism remained high as COVID-19 cases surged, driving the continued collapse of the financial markets. The market's response reflected ongoing concerns over the pandemic's impact and the effectiveness of the policies implemented to counter the economic downturn. Zero interest rates. In an emergency meeting on March 15, 2 days before its scheduled meeting, the Federal Reserve implemented a zero interest rate policy, slashing the target interest rate to 0.00 to 0.25%, marking a significant return to zero interest rates for the first time since December 2015. To maintain market interest rates within this range, the Fed employed various tools like open market operations, reducing the reserve requirement ratio for banks to 0%, and lowering the interest on excessive reserves to 0.10%. Additionally, the Fed cut the primary credit interest rate for discount window borrowing to 0.25% per year and extended the loan period to 90 days to ease bank liquidity pressures, as demonstrated by the surge in discount window borrowing. During this time, despite the stigma associated with borrowing from the Federal Reserve's discount window, banks increasingly relied on it due to the severe liquidity crunch prompted by COVID-19. With interest rates already near zero, the possibility of further reductions implies moving into negative territory, an option the U.S. has historically not pursued and which Federal Reserve Chairman Jerome Powell has indicated is not favorable. This scenario underscores the limitations of the Fed's conventional monetary tools in mitigating severe economic downturns. Quantitative easing. In response to the economic strain caused by COVID-19, the Federal Reserve announced a $700 billion quantitative easing (QE) program, purchasing $500 billion in U.S. Treasury bonds and $200 billion in agency-backed mortgage bonds. QE, an unconventional monetary policy tool, is employed when traditional methods like target rate changes are inadequate, especially when open market operations don't effectively impact long-term rates. By buying long-term government bonds, the Fed increases the money supply and directly influences long-term interest rates, aiming to reduce them and thereby lower overall borrowing costs. This strategy is intended to stimulate investment and consumption by lowering interest rates across the market, including those benchmarked against long-term government bonds like the 10-year Treasury. Additionally, QE improves banks' lending capacity by raising the prices of government bonds they hold, simultaneously signaling the Fed's commitment to revitalizing the economy through substantial liquidity injections. This move by the Fed underscores their determination to address the severe economic downturn and stabilize financial markets. To ease the tightening of the U.S. dollar in foreign exchange markets, the Federal Reserve reduced currency swap interest rates with central banks from 5 major economic regions, expanding this to 9 additional countries amidst ongoing global foreign exchange instability. These swaps are essential in credit crunch scenarios, allowing central banks to supply dollars domestically. Despite announcing a return to zero interest rates and a $700 billion quantitative easing initiative on March 15, market instability continued, leading the Fed to reintroduce the commercial paper funding facility and the primary dealer credit facility from the 2008 crisis. These measures aim to stabilize short-term money markets and provide liquidity to credit-worthy companies and primary dealers. As the crisis deepened with statewide lockdowns and panic selling, the Fed also introduced the Money Market Mutual Fund Liquidity Facility to prevent asset value collapse in money market mutual funds. These actions represent a comprehensive approach to managing the severe financial and economic impact of the COVID-19 crisis, demonstrating the Fed's commitment to stabilizing markets and providing liquidity where needed.